Hello and welcome to chapter 9 of the Accounting Insight tutorial series. This chapter deals with stocks of goods are yet to be sold. We've now reached the end of our trading period, and a business should find out how many items of goods they still have in stock that they haven't yet sold, and try to put a value on them. To do this, we carry out the following steps. We're going to go through the purchase invoices for traded goods and also the sales invoices and credit note. And we're going to list out the stock quantities that in date order that came in and went out of the business during the process of buying and selling the goods. So the first two I've done for you. So if we go to our work pack, so obviously you'd buy the goods first. So let's go to purchase invoices. So this is not stocks of goods. This is stocks of goods. So on the 10th of January, we got that there. We purchased 10 computers, and you can see the quantity of goods there. And at the end of that day, we had 10 computers in stock. So we bring the balance of that down to the following period. So I'm going to go to the next trading event, and according to this, it was actually a sale. So if I go into sales invoices, which is here, so our first sale was on the 15th of January, and it was for 4 computers. You can see I put the information there, and 4 computers, which brings the total stock of goods down to 6. We're going to go to the next trading event, and I know the order of the invoices, so I can tell you it was on the 21st of March. It was a sales invoice. So let's go to the next sales invoice here. There you go, 21st of March. And it was 6 computers sold. So I'll put the value in here. Put the date, 21st of March, 3,000. And we sold 6 computers. So now you can see we had a balance brought forward of 6. We sold the 6 with balance left of 0. So the next trading event obviously would be to buy more computers, and I can tell you it was on the 2nd of May. So if we go to purchase invoices, scroll down here. So we've done this one already. You can see the date there. That's not stocks. We're looking for purchase of stocks. Neither is that one. That one. So yeah, 2nd of May, we bought 6 computers. So we enter that in here. 2nd of May, 3,000. And we bought 6 computers. Okay. And the next trading event, I can tell you 2 sales on the 25th of May and 15th of July. So we can confirm that. So it's a bit of work as you're doing this. If you're working with computers, as you create the sales invoices and purchase invoices on the system, and if you're using stock record, it will automatically update the stock record. Here we're doing it manually, so we're going back and forth. And because we're trying to show you in different stages how to compile a set of accounts, we're going back to these records to see what we had. So yeah, so the next trading events were 2 sales, 25th of May. So I go to the sales invoice, which is we'll go on 25th of May. There it is. And that was, put that in there, 25th of May, 3,000. And that was a sale of 3. You can see the value there, 3 computers. So minus 3. And the next event was 15th of July. 15th of July, another sale of 3 computers. So enter 15th of July, 3000. We sold 3 computers. So now we're down back to 0. So obviously we'll have to buy more stock. So I can tell you from answer book here is a purchase of stock on the 2nd of August. So if we go to our purchase invoices, scroll down, 2nd of August. It's not that one. Not that. 2nd of August, yeah, 10 computers. So 10. So 2nd of August 2000. We've got in 10 computers. So now our stock has gone up to 10. And I can tell you after that there were 2 sales, the 15th of August and the 15th of November. So if we go into sales, it's down here, Appendix A work pack. So we've done that one 15th, we've done 21st March, we've done 25th May, we've done 15th July, and 15th August. So sale of 4 computers. So the 15th August 3000. Another sale of 4 computers. So it brings the stock down to 6. And then the next one was 15th of November. Scroll down. Yeah, 15th of November, you can see there. 15th November 3000. Another sale of 4 computers. So enter that. So we're now down to 2 computers. And remember, we had a credit note. Somebody returned a computer. So it was the coffee shop. There it is. That was on the 2nd of December 3000. This person returned the computer, so we need to increase our computers. Let's assume there's nothing wrong with it. It can be sold again. So our stock now is 3 computers. So once you've done that, you can check your answer to the answer in the book, the back of the book. And I'll now talk a little bit more about stock. So we've done the stock record. We found out at the end of the period there are 3 computers left, and if they ask you to value that stock, normally you'd value it based on the last purchase invoice you had, in which case it was the purchase invoice for the 15th of November. So if we go to our work pack, our purchase invoice, and the last purchase invoice for stock was the 15th of November. It's August. Oops, scroll too fast. Sorry. Yeah, was it? Oh no, sorry. The last purchase of stock was 2nd of August 3000. So yeah, each computer was £500. So the value of these 3 stock items, we can value them at £500 each. That is 1,500 in total. Now this method of valuation is based on an assumption that the first set of goods that you bring into your warehouse will also be the first set of goods you sell out. So it's called a first in, first out method of valuing stocks. There is also a last in, first out method. It depends on the type of business, which method is appropriate for your business. You probably need to speak to an advisor to see what's the best method of valuing stock in your business. Most businesses do a first in, first out method. And so in this case, we've only got one stock item, which is computers, and that's easy to track. Obviously, you can imagine a bigger company will have lots and lots of stock items, and all their stock records will be done automatically as the purchase invoices are being created, or the purchase orders and purchase invoices are being created, and when the sales orders and sales invoices are being created, their stock record would be updated automatically. As you can see, it's quite a bit of work trying to compile this. Some businesses don't do this. They actually just go and count the stock at the end of the year and say that's our stock. The problem with that is you don't know if you're missing any items of stock from your record or from your warehouse. And also, when you have a stock record that is automatically updated as you're doing your accounting, you can also have a reordering system automatically working off that, telling you now you need to replace these computers because you're going to be running out of them in the next week or so. So you automatically buy the stock. So it kind of helps with stock management. So that is stocks. Basic idea. Most people can understand this. It's physical items coming in and going out. And I'd like to say thank you for staying with this tutorial series up to now. You've done all the records of our sample business. So the next few chapters, I'm going to introduce double entry accounting, which you've actually been doing as you've been doing the exercises. I've been hinting about it. And then we're going to pull all the records together and start creating our trial balance and profit and loss account and balance sheet. So a bit more technical accounting is coming up, but because you understand all the records of this business, I'm sure you'll be able to understand what we're talking of when we come to the compiling the financial statements. And if you feel you need to get more familiar with the records you've been compiling, please feel free, read the chapters, redo the exercises if you want to. Anyway, thanks for staying with me up to this chapter, and I hope to see you on the next chapter as we end up going to the final part of the book. Thank you.